Hi, this is Mike Regan, and it is my pleasure to welcome you to another On the Record session with our friend David Ross. David is an executive vice president with Roadrunner. I've known David for several years, and the reason I'm so excited is because of David's background. He's going to briefly explain it, but just for those of you who may not know him, David spent 20 years on Wall Street, and prior to joining Roadrunner, he was the managing director of Stifel's Global Transportation and Equity Research Group. He was a driving force for a couple of years in their equity conference that they put in February. Really a student of the industry, and delighted to welcome you, David, to this On the Record session with our TranzAct listeners.
Thanks for having me, Mike.
All right, David, let's jump right in. You and I, you helped me participate in a call for some presidents in YPO, and really the thing we're looking at in this particular On the Record session is to help shippers understand some of the significant changes that have occurred in the LTL industry. I think one of the things we've highlighted in our 2-minute warning is that there have been significant changes, so that what you're seeing today is different than what you were seeing a year ago, 2 years ago, pre-pandemic, 3 years ago type thing. So we really want to help our listeners understand how the LTL carriers are managing their business, how they're interacting with their customers, and how this has impacted the pricing function. So could you walk us through a little bit today about what's going on in the LTL industry, where we're at today compared to where we were at a year, 2 years, 3 years ago?
I'll even take it back a little bit further than that, Mike. We haven't had a new LTL carrier of significance, I would say, start up in about 30 years. So there is a fundamental limit on the capacity in the LTL space. And during that time, there's been consolidation within the space. So while the real estate and the transportation infrastructure, which I call the long-term capacity of the LTL industry, has been fairly stable, the number of competitors, the number of decision makers, and the number of people negotiating rates with shippers has actually gotten smaller. And so in a period like we have today, where there's growth in demand and there's fundamental constraints on supply, it really is driving rates significantly higher and putting the ball squarely in the carrier's court. And even carriers that would like to expand are limited by both labor and real estate constraints, which we can get into later. On the demand side, the industrial economy has been rebounding. Plus, you've got the growth in e-commerce, which requires more frequent shipments of smaller order quantities that shift some freight from what would traditionally have been truckload 10, 20 years ago into more of an LTL network.
Okay, so, David, you bring up a really interesting point that I hadn't thought about. You're saying we haven't had any new entrants of any consequence into the marketplace in the last 30 years. Okay, so we're not like expanding our capacity, yet demand is continuing to rise. Okay, now you marry that up with, could you also touch on some of the other evolutionary phases that the LTL carriers have gone through, just in terms of the technology and level of data that they're using to manage their business?
Yeah, there's a couple of things. There's what you call the use of data, because they've had data for a long time that was not, I would say, taken advantage of. The technology that they've applied, and this is where you get into our view that technology is a tool, technology is not really a solution, but anytime you have a network, hub and spoke network, a consolidation network like parcel or LTL, it's very important to understand the costs, because truckload, the costs are fairly easy. You take a 53-foot load from point A to point B, you know how much fuel it costs, you know the driver's cost, and they're just taking up that equipment. It's very simple. LTL carrier, similar to air freight, similar to parcel, again, they sell space. And so because you're consolidating multiple shipper shipments on a single trailer, you have to determine, okay, how much space does that shipment take up in my trailer? How is it being routed through my network? What are the costs of pickup, costs of delivery, costs of handling? And technology has helped carriers better understand that over the years, whereas they were taking more or less shots in the dark or making broad assumptions 10, 20 years ago through the increased use of dimensioners, inbound, outbound gate scanners, handheld technologies. they're better able to really capture the cost of their freight and then translate that into pricing so they can get more accurate pricing around what's going on right now.
So, I mean, just to follow up on that, I guess you'd be in agreement. You know, we've had the privilege of talking to some of your contemporaries in the market. Darren Hawkins, for example, a good friend of ours from Yellow. He brought up an interesting point. He said, you know, Mike, with dimensionalizers, we can now measure freight down to the inches. And with ELDs and other geofencing applications, we can now measure time down to seconds if we want, but certainly minutes. And so what he was kind of highlighting there is we now have a much better understanding of how our equipment is being used and the requirements that are being imposed upon us by shippers. Is that kind of what you're going towards with this, you know, use of technology and the amount of data that's out there?
Yes, and in simple terms, it comes down to time and space. How much space does the shipment take up, and how much time does it consume? Because those are really the cost buckets when you look into equipment and the space, and then time and the driver and labor issues. That's really what it boils down to. But you have to have the data available, and then you have to use it properly to really get at that answer.
Okay, so let's shift gears a little bit and talk about, you know, shippers out there go through this annual ritual called sourcing, running RFPs and all this kind of stuff. Can you talk about how these changes have impacted the sourcing function? And specifically, one of the things that you and I had talked about a couple of months ago over dinner was the fact that with the amount of data that you have, you're now able to target each shipper and determine the profitability on an account by an account basis, whether that shipper is part of a larger portfolio of freight, like through a 3PL, or on a standalone basis. Can you just walk us through the assessment process, how a Roadrunner or LTL carriers are going to look at that?
Yeah, I would say the way we look at it and the way most carriers look at it is how the freight fits into the network. And really, rather than, okay, there's 100 shipments a week coming our way, does it as a group make money or not? Really evaluate it down at the lane level. Are we making money in all these individual lanes? Do we want all these individual lanes? Do they fit our network? Do they not fit our network? And really it gets into, and this is something that the shipper should also be looking at, because just as the carriers are looking to select the freight that fits their network, shippers should look to select the carriers who fit their network. Because Roadrunner has a different network than Old Dominion, has a different network than XPO, has a different network than Saia, has a different network than Estes, has a different network than R&L, et cetera, et cetera. And what might be, say, a $400 shipment at one carrier is a $500 shipment at another carrier, just based on their different cost profiles or infrastructure. Depending on where their facility is located, in proximity to the shipper's location and the consignee's location, how much freight they have moving in certain lanes. So really it's become more of a surgical process on the carrier side, and I think it should become more of a surgical process on the shipper side. To that end, to help us internally at Roadrunner at doing this, we really have recently redefined our network and I would say refocused the network so that we can better manage it for shippers and for quality of service. When I got to Roadrunner about 6 months ago, we had something like 34 origin points and 86 destination points, which doesn't really make sense in a network. It's kind of like saying, oh, United Airlines will drop you off in Denver, but you got to get back on your own. And so now we're really down to about 32 origin, 32 destination points in high volume major metro areas across the US. So what we now want to do very well as we transition from a low cost carrier to really a quality service, more focused provider in the LTL market.
So, let me just jump on that for a minute, because I think it's really a key point that we've been stressing in our 2-minute warnings and our webcasts and this type of thing. So the traditional sourcing event says, well, these are the carriers that we've done business with in the past. Certainly we have to include them in the RFP process And so, we've got time constraints and, we're shoving 20 pounds of activity into a 5-pound bag, so, this is the way we have to run the sourcing event. And the point that you're raising there is one that we've been trying to help people understand, that your freight as a shipper has a different value based on the carriers you're selecting. And so I just want to underscore and make sure I get it right. Like you said, the value of your freight to Old Dominion could be X. The value to that same freight could be Y to XPO. And so that's going to be adjusted for in their rates. And so what you're saying, and this is where I think a lot of shippers don't really understand the magnitude of the changes that are going on. You're saying as Roadrunner has transitioned from low cost to service oriented, your lanes have significantly changed, so that the network that shippers saw 2 years ago is completely different than the network that exists today. Is that kind of an accurate summation?
That's an accurate summation. And really in this market, what that ultimately means for the shipper is that you should not be doing things the way you've always been doing them. Going back to the same 5 core carriers and trying to get a better rate or fight them on something or another is not the ideal solution. A better solution is probably to invite other carriers that you haven't worked with before, maybe haven't worked with in a couple of years, to see if your freight might better fit their network. And having more carriers essentially bid on your business is going to get you the best price, not beating up carrier A, B, and C that you've had 20-year relationships with, because their network is their network. And there's value to consistency. And I think that is also important, but it's really this freight matching, piece, between the shipper network and the carrier network that's so important.
And let me just touch on something, and then we'll move on to another key point. But I love to give this example because it happened in the past 5 months. We had a very large LTL carrier, it's a great carrier, come in and basically say, here's a 14% increase. And we were like, 14% increase, the shipper, we better bring the paddles because we're going to be doing some resuscitation, when their heart stops, their palpitations of the heart. And so, obviously we've done billions of dollars of sourcing events and that kind of stuff. And so, we take a look at the OR data, we come from a CPA background, audited motor carriers and that type of stuff. And then the carrier said, well, here's the alternative. If you'll get rid of or give 3 lanes that represent about 20% of our volume, if you can put those on another carrier, that 14% increase will go down to about a 5% increase. And that was kind of open our eyes. I mean, we were well aware of it, but to the surgical precision that these carriers have the ability to exercise in terms of maximizing their returns on their assets, which is what every good carrier wants to do. Is that an aberration, or is that directionally you see more of that happening?
Directionally see more of that happening, and ultimately it's good for everybody, because what that is doing is ultimately forcing the shipper again to increase its carrier base to get a lower cost. And the shipper has the option, okay, well, we can take this 14% increase and keep working with the same carriers, or maybe add somebody new to the mix and really help avoid some of these cost pressures that are inevitable.
And I just want to jump in here because that is almost antithetical, the opposite of how shippers have been approaching the sourcing event for years, and the carriers bought into it we say the carriers, when they had a market-based pricing, AKA get as much business as possible. The thought was, if I consolidate the freight and give it to just fewer carriers, those carriers will give me a better price because I've got more volume. And so what we're trying to help people, I think, is exactly what you're saying. It's not the volume that's driving it, it's the fit of that volume within the network.
And it's the volume by lane rather than overall volume that's so important. And that's one of the reasons also that 3PLs are not having basically the 3PL model is changing to more customer specific pricing with carriers rather than overall blanket rates, because the 3PLs used to just say, we've got 2,000 shipments a day. What kind of rate can you give us so that we can go out and resell it to our customers? And when the carriers didn't know their costs,
yep,
surgically, strategically, that was the best way to go about it. But now that carriers are more focused on lane profitability, it really is, carriers are pushing away a lot of the blanket pricing and pushing for more customer specific pricing. They still love 3PLs. They like working with 3PLs. 3PLs are valuable strategically to carriers. Just the way pricing is working is different. And that's being reflected both on the 3PL side and the major shipper side.
Yeah, so you had said something to me, and I may have mentioned it earlier, but if so, it's worth repeating again. Over dinner, you said, Mike, let me make it real simple. Why do we want to go and give our assets to freight that's running at a 96, 97 OR when we're turning away freight that's running at an 82 to 85? I mean, that's just logical. It's like Rob Estes, we've interviewed numerous times. He said, I'm going to make it so simple that even a guy from Illinois can understand, Mike. He said, we sell space. If you help us utilize that, like one pallet a couple of years ago to Estes, one pallet position per day for Estes, according to Rob, it's in an interview at TranzAct.com. One pallet a day was worth $5 million to his bottom line. One pallet per day. Let's move into something else as we kind of wrap this up. And that is, one of the things that you have been a champion at mentioning at the conferences, and you've certainly got all the contacts in the world with the carriers, and obviously now at Roadrunner. The words shipper of choice have been around for a long time. And so one of the things I like to highlight for folks is that coming out of 2018, when we had a little bit of a dip in freight in 2019, I said, somehow, some way, shippers got amnesia and said, okay, well, we don't have to be a shipper of choice now because the carriers need us more than we need the carriers. Well, one of the things we've seen now with 2021, 2020, the third and fourth quarter, demand is likely to remain strong. Like you said, we've limited capacity, so it's not like we can go and add a whole bunch of LTL capacity. Can you help me understand a couple questions about shipper of choice? From your perspective, what does it mean for a shipper to be a shipper of choice?
Simply, a shipper of choice should be one that communicates effectively with its carriers in a timely manner and is a consistent partner through the cycles. Now, shipper of choice, as you mentioned, has often been used during short periods of capacity tightness and then kind of disappears, similar to the driver shortage. We've been talking about the driver shortage for 25, 30 years. And it really is gets very loud for a year or so, and then it disappears, then it comes back. And shipper of choice is generally followed that pattern. This cycle is different in that not only is it likely going to prove longer than past cycles, it has already been steeper. And you can look at that on the truckload, the LTL side, and it's across the mode. Same thing on air freight, same thing on ocean freight, likely on intermodal as well. It's just forcing shippers to take a look at their business harder than they have in the past, and may finally cause some permanent changes, because shipper of choice in the past might have been somewhat like lipstick on a pig, where they play nice for a period of time to try to mitigate the rate increases. But it's somewhat akin to, you don't want to wait until April or May to try to get in shape for the beach. It's better to take care of yourself year round and eat well and sleep well and drink plenty of water, rather than try to hit the gym feverishly, all through the late April and early May, just so you're looking better on the beach. And the shippers that prove through the cycle that they know where their lanes are, they know what their shipments are, they communicate timely and accurate data to carriers, those shippers will get the best price available. They will also get capacity, which is even more valuable than price in a time like today. And so really it goes back to communication and reliability.
Okay. Can I bring up one other thing that you perhaps can address for there? I mean, this is, I will just tell you, every LTL shipper needs to hear what you're saying here. Okay. But one of the things that when I had Derek Leathers on a YPO call, he said, he brought up this being a steward of the carrier's assets. Something that Rob Estes had brought that, a lot of shippers aren't thinking like this, that, that truck, when that truck pulls up to your facility, that truck is pulling into your facility at a fully loaded cost of anywhere between $90 to $110 per hour. When I take a look at the fully loaded cost, driver, equipment, all the ancillary costs. So, if you're, if you're giving a carrier a lot of single pallet minimum charge shipments, that's going to have a real bad impact on your operating ratio. If you take an extra 15, 20, 25 minutes to clear that carrier into and out of your facility, it's going to have a real bad impact on your operating ratio. But he said also one of the things that, and I'd like to just have you touch on this, whether we're sharing some relevant information. He said the other thing that offline is the lack of information that shippers have about what's going on at their customers as well as suppliers is something that makes that shipper of choice program, you've got to bring it, it's got to be a way of life, but it makes it more difficult to implement because you're not aware of all the factors that the carriers take into account. Does that, you follow where I'm going with that? Could you amplify that, or?
Yeah, you're 100% right. So I would add to communication and reliability, efficiency is the third piece of it. And that's, what we've called carrier friendly freight. Because when you think about the cost buckets for a carrier that I mentioned earlier in the LTL system, there's the cost of picking up a shipment, the cost of handling the shipment, the cost of moving it through your system, and the cost of delivering it. Well, on the pickup side, as you mentioned, there's a different cost if you get that driver in and out in 20 minutes or an hour and 20 minutes. And that's going to be reflected in pricing. So if the shipper's dock is not appropriately staffed, if they don't have enough dock doors, if the carrier is spending time waiting, well, that's going to result in a higher price. If you can get that carrier in, get them out relatively quickly, that's going to result in a lower price. And you mentioned, the consignee side. Well, that's an area also that some shippers aren't aware of, which what happens on the other end, as you mentioned. And so getting that information too will also potentially lower their price, because they could be efficient. They could get that carrier in and out on the front end when they pick up the freight. But when it goes to get delivered, they might be making the carrier wait for 2 hours. Now, if that's the case, that's going to add a lot of cost to that shipment. And all they have to do is call the receiver and say either we're going to give you an upcharge because it's costing us more to ship you the freight, or here's what you have to do: just have a little extra staffing, get these guys in and out quick, and you can get the best price available.
So, let me just jump on something here, because, one of the things that we hear from shippers is, how does TranzAct get this data and this type of thing? And I say, well, we asked for it. But, they say, well, our carrier won't give us that information. One of the things that really, really impressed me about your efforts as the EVP there at Roadrunner is your commitment to transparency and sharing data with customers and shippers. You're transitioning, like you said, from low cost to service oriented. If a shipper comes to you and says that we really want to understand the costs that are driving, our relationship, you share that, don't you?
100%. I mean, everything we're looking to do is win, win, win. So if it's good for the customer and it's good for us, it's good for our employees, it's good for our drivers, we want it to be efficient. We want to give the customer the best price. We want their freight moving as fast as possible. We want all of the data. We want to provide them visibility, and we want to get visibility from them to make it as seamless as possible. Now, it's easier said than done. There's a lot of work that goes on behind the scenes to get there. But really, that is the goal, is to increase the transparency so that all parties are doing better.
Great. David, let me just throw one other thing out, because I think, one of the things that we talked about, we've been doing our 2-minute warnings forever and a day. And the most recent one that we put out was dealing with black swan events. And you know, one of the reasons I bring up this whole concept of you know, black swan events is, you know, briefly, if you could touch on some of the cost factors that are on your radar screen from an LTL perspective, not just from Roadrunner, but listen, you know, you as a managing director of Stiefel, you're an industry expert. You know, other things like we talked about briefly, like $1 billion judgment, you know, the nuclear verdict issue, the operational cost of equipment, things like that. Are these things that shippers should have some kind of awareness of because it impacts your ability to service them? Could you just briefly touch on those types of things?
Absolutely. And I think a lot of shippers are aware of it, especially those that have private fleets. They get the cost of equipment, they get the cost of insurance and liability. And even the shippers that don't have fleets, they have dock workers, and the dock worker shortage is very real. Labor is an issue across the board, whether you talk about mechanics, dock workers, or drivers. We're seeing Starbucks, McDonald's taking significant wage increases for their employees, signing bonuses that we've never seen in the fast food industry before. And that applies in the transportation and supply chain industry very much. You know, so our costs are heavily labor in the LTL side. And so drivers aren't getting any cheaper. Dock workers aren't getting any cheaper. Real estate has really exploded. You know, not only the cost of real estate, but the availability of real estate and the process for expanding real estate. You know, other carriers that I've talked to over the past couple of years that are making money, that are trying to expand to service more customers and add more trucks, and even have the land or buildings identified, just because of this odd pandemic period we've been in for 1.5 years now. The process through government or regulatory agencies to get certain approvals for land building expansion development is being delayed and delayed and delayed. So that's keeping constraints on the network, which is driving price up. You mentioned the recent verdict in Florida of $1 billion against a couple carriers. Guys, you know, were texting and driving while operating a Class 8 tractor. That's a no-no.
That's a bad idea.
Bad idea all around. And it was about 900 million in punitive damages of that billion. And although those carriers are never going to be able to pay it, and you know, it was more of a headline issue that is noticed by lawyers and it's noticed by insurance companies. So the cost of insurance is going to continue to go up. And you know, the cost pressures on both sides are real. And it's just through that increased transparency, through increasing your carrier base, or at least the potential carrier base, to best manage your shipment network with carrier freight networks. You know, that all works to everybody's benefit.
Okay, let's just final question there, and I really appreciate your time, and that is looking forward into 2022. Demand stays strong, capacity remains tight throughout 2022. Yes or no?
I think capacity remains relatively tight. Demand is a bigger wild card, but there's tailwinds for demand going into next year, largely in the inventory side.
Yeah. As
I travel around the country, meet with shippers from all industries, inventories are very, very low. Ships are parked outside of the ports. You know, there's not enough trucks to get it in. So even if people stop buying stuff tomorrow, there's a lot of freight that's still going to be moved just to get inventories back to reasonable levels. And then we move further in 2022. Who knows what's going to go on with consumer spending and interest rates and capital spending and all that fun stuff. But the constraints in the LTL industry are real. Truckload, some limitations, but there's still new trucking companies being created. It just hasn't been enough new truckers come in to relax the rate environment yet. Maybe that changes in 2022, but certainly we expect going into next year relatively tight supply demand still.
So with that thought in mind, we sent out our 2-minute warnings about budgets and all, and we lit up the scoreboard, had almost 3,000 people check out our 2-minute warning on budgets. One of the things that we issued guidance on, on the LTL increases, if assuming you've got reasonable rates right now, you're probably looking at somewhere in the area of 5 to 7, 6 to 8% rate increases on the LTL. Is that consistent with something that you see as an expert in the industry?
That's absolutely in line with what I was going to say. A lot of the big resets on rates have happened this year at higher levels, but even going into next year, I think you're looking at mid-single digits again.
And then on the truckload side, if you don't mind me taking advantage of, you know how much I respect the work that you did at Stiefel and the Stiefel team and John Larkin and the whole group there. I sit on the board of a publicly traded truckload carrier. We get a wealth of data. I think one thing that shippers are completely, some of them may not be, is the level of increase in driver pay this year. Early 2020, the drivers were making 60, 61. Now they're making 75, 78, 81,000 type dollars. And, so on the truckload side, is something in the 8 to 10% area a practical suggestion on the truckload side?
I think the range should be wider. The truckload industry is much more fragmented than LTL. So you're going to have a higher volatility rate around rates. So that would translate into higher highs and lower lows. So I would say something closer to 5 to 10 rather than 8 to 10.
Okay. Well, I can't reshoot the 2-minute warning. So we'll just leave it at 8 to 10. No,
well, if they budget 8 to 10 and they come in at 7, they'll look like heroes. So,
well, the other thing that's the wild card is we're seeing some stuff on the ocean market that just shows no signs of letting up anytime soon. And that our friend Peter Tershwell brought up the fact, there've been so many black swan events in 2021, the impact like we're seeing now that with hurricanes coming out of hurricanes, just Ida and Henry, shutting down the ports, this disruption in the Southeast, those are having significant impacts on the ability of carriers to move freight and what they have to charge to get the freight moved. And that's why we were talking about black swan events, is having something in your budget that sets a heads up to people that these numbers could change based on extemporaneous events over which we have no control. So
yeah, we've always said that shippers won't pay a penny more than they have to for transportation, but they'll pay whatever they have to for transportation.
Wait, can you repeat that? Pay a penny more?
Shippers won't pay a penny more than they have to for transportation, but they'll pay whatever they have to get transportation. It's just so vital for business, the economy, how everything moves. And there's been this general theme of overcapacity since deregulation and relatively available capacity. And that's tightened up a couple times through cyclical periods, but we're at the point now which seems a little bit different. And that's why we've seen 10x increases in ocean freight, 5x increases in air freight, doubling of truck costs. It's serious this time, and shippers are still paying it because they have to. That's their business. They sell products, they need the product moved, and supply chains are fundamentally going to be changing as a result of this. But that's probably something for another webinar, Mike.
Yeah, well, listen, you've been great. By the way, said, I don't know if you saw the Gartner survey that said only 17% of the companies they surveyed have quote unquote fit supply chains, which they defined as supply chains that can recover from the impact of high impact events, high things, those black swan events. David, just this, I can't thank you enough. Did I miss anything that you want to share? I mean, one of the things you really highlighted, and I just want to go back to this, is now Roadrunner, and this is in part your effort and your executive team, laser-like focus on the lanes where we really want to do well. And now by concentrating, we can transition. Anything else that I may have missed that you want to share with your audience?
Not so much. I think we've upgraded the team at Roadrunner. We've refocused the team at Roadrunner, and the analogy I use internally is a restaurant one. We'd rather be a really good Mexican restaurant and have the best tacos and mole around than be a diner where you can get waffles and shrimp and filet and chicken sandwiches and pizza and everything else. Like we want to do what we do very well, and that's where we're focused, and that's what we'll continue to do. So thank you for providing us the opportunity to talk about it a little bit here today.
So if you want great tacos, give you a call.
Absolutely.
Hey, David, thanks so much for your time.
Really. Thank you, Mike. Always a pleasure.